You've probably seen the memes going around on social media. Business owners are photoshopping Anthony Albanese into their workplace, welcoming him as their new 47% silent partner. And look, they're funny because the guy's serving coffee, laying concrete and stocking shelves. Here's mine. Albo actually flew to Perth to visit the office. Didn't even knock, just sat down and started reviewing client files. Very hands-on for a silent partner. But I want to show you something because the 47% number that everyone's throwing around doesn't actually hold up when you look at a real scenario. So I'm going to walk you through a client of ours, a real client, a profitable business, and show you the actual tax they pay while running the business. And then what happens when they sell it. And the numbers are very different to what the memes would have you believe. So this is a real client and they run a professional services business and they've got my preferred structure, which I'll draw out for you now. You've got the trading company at the top, which is 100% owned by an investment company, commonly called a holding company. And the holding company is 100% owned by a family trust. Now, the beneficiaries of the family trust are the director of this business and his spouse. So this is now the preferred structure since the budget announcements that rendered bucket companies useless. Now, this is a good business, they're profitable, and the trading company made a profit last year of 1.3 million. So let me show you how that flows through and where the tax lands. Out of the 1.3 million, we've got 1.1 million getting paid down to the holding company, right? That leaves 200,000 in the trading company. And out of the 1.1 million that gets paid to the holding company, 645,000 gets distributed down through the family trust to the two individuals. So this leaves 455,000 in the holding company to be invested. And out of the 645,000 that goes to the family trust, 180,000 being distributed to the director's spouse and the rest to the director. Now, the reason such a large chunk goes to the director is because the director is the one running the business and this is a professional services business and the ATO has specific rules about how they expect to see profit flowing from these types of businesses to the family group. They want to see a certain amount of income in the director's name and they want to see a certain percentage of tax paid across the entire group. So we're choosing here to work within those boundaries. Now, let's look at the tax that's going to be paid across the group. Okay, so the trading company has got $200,000 left in it and the tax rate is 25%. So the tax is, of course, $50,000. And the investment company also has a tax rate of 25%. And so the tax on $455,000 is $114,000. Now, the tax to the spouse on $180,000 of income is about $51,000 in tax, or about 28%. And the director pays $185,000 in tax on their $465,000 of income. That's the top marginal tax rate, and yes, that's a big number. But when we add up the total tax for the group, we have here $400,000 in total of tax across 1.3 million of profit. Now, that works out to be an average tax rate of just under 31%. So yes, the director is personally paying a lot of tax, a lot of it at the top tax rate on their portion with an average tax rate of 40%. Now, nobody's arguing that tax rate is low, but across the whole group, the effective rate is 31%. And this is a business owner who's taking about half of the profit out for personal use because they've got a mortgage, they've got kids at private schools, and they've got a lifestyle to fund. They're spending $645,000 a year, and the other half of that stays inside the companies, compounding at the lower tax rate. That's a long way from the 47% memes that we're seeing online in social media. Now, the other half of this is what happens when they sell the business. Because I think a lot of business owners see those memes and the real fear is about the exit. I even had a business owner on the phone with me today asking if he had to pay 50% of his business sale in tax. So let's say this business making 1.3 million a year in profit sells for 2.5 times the profit. That's 3.25 million. the business owner originally bought the business for $1 million. So the actual capital gain is $2.25 million. Now, the 50% CGT discount is going away and it's not available to companies anyway. So I'm going to ignore that in this example. But there are separate concessions called the small business CGT concessions. And this business qualifies for them. The first one is the active asset reduction. That's a 50% discount on the capital gain for eligible small business assets. So we take the 2.25 million and we halve it. And now we're working with 1.125 million. Then there's the small business retirement exemption. Each individual can contribute up to $500,000 into superannuation under this concession, and the money goes in tax-free. So the director puts in $500,000 and the spouse puts in $500,000, which is $1 million in total going into super. That leaves a taxable gain of $125,000. At the 25% tax rate, the tax on that is $31,250. So on a $3.25 million business sale, the tax is about $31,000. Now, if the business owners don't want to put the $1 million into super, that's their choice. But then the tax applies to the full $1.25 million, which at 25% is about $281,000. The difference between putting the money into super and not putting it in is the $250,000 in tax. So most people opt for the super contribution because the maths is pretty hard to argue with. One more thing to note here, if you're over the age of 55, the company can pay you the $1 million rather than putting it into your super. But what if you want to buy another business? Well, instead of putting the $1 million into super, you can instead use it to buy another business. This is called the small business rollover, and it defers the tax on that $1 million until you sell that second business. Whichever option you choose to go with, you're paying $31,000 tax on a $3.25 million business sale. Okay. There's one more scenario which you may have heard of. It's the 15-year exemption. If the trading company has carried on the business for at least 15 years and the individuals are over the age of 55, under that rule, the company can pay the full $3.25 million out to the individuals completely tax-free. Now, there's no super contribution required, but it can go into super if you want. And again, it's completely tax-free. So, two scenarios if you're over the age of 55. If you've had the business for less than 15 years, the company in this example pays you the $1 million or puts that $1 million into your super. The rest of the proceeds from the business sale remain in the company and then you invest it there. But if you've had the business for over 15 years, the company pays you the entire $3.25 million or puts it into super for you. This is obviously much better because you get the money out of the company completely tax-free. If you're under 55 years old, you don't have access to the 15-year rule. So you can only rely on the retirement exemption and putting the $1 million into super. Or you can find another business to purchase for $1 million or a combination of those two. Now, I do need to flag something because I don't want anyone watching this thinking they can just do all of this themselves. These small business CGT concessions are full of trips and traps. It is genuinely one of the easiest areas of tax law to get wrong, and the consequences of getting it wrong are severe. If you don't qualify or the concessions are incorrectly applied, you lose access to all of them. And then you're paying 25% tax on the full $2.25 million capital gain, which is $562,000 in tax. Plus, the balance of the proceeds gets stuck in the company because you can't distribute it out under the concession rules if you didn't get them right. The difference between getting this right and getting it wrong is the difference between $31,000 in tax and a $562,000 tax bill. So if you're in this position, you need to get proper advice and you need to pay for that advice because the cost of the advice is just a fraction of what you'd lose if you've got it all wrong. Now, even when you do get the concessions right, you'll usually have some balance left in the company that you can't just pay out to the individuals because ordinarily a company paying money to an individual is a dividend and gets taxed. The way we handle that is the trading company pays the remaining proceeds down to the investment company, and the investment company invests it. Then over time, it drips out dividends through the family trust to you, the individuals. It's a very tax-effective way to access the money over the longer term. If you're a business owner and you want to know whether your structure would give you this kind of outcome, whether that's while you're running the business or when you eventually sell, there's a link below to book a call with our team. We'll look at your setup, your numbers, and we'll tell you where you actually stand.